Welcome to Wealthy_Business. Today, we're talking about dividends, what they are and what they mean for investors. What are dividends? Dividends are regular payments of a company's profits to its shareholders. They are a kind of reward for investing your money in the company, similar to how you'd receive interest for money in a savings account or a bond. How dividends work. Most often, companies pay dividends in cash, but they can also give additional stock to their shareholders. Why would a company do that? It's a way to reward their investors for putting their trust and money into the company. Companies with extra money have two options. They can either pay shareholders in the form of dividends or reinvest that money into their business. Who pays dividends? Typically, the board of directors will distribute dividends if they can't get a high return on investment by using that cash to grow the company. Older and more stable companies are more likely to pay dividends as their growth has slowed, while newer companies tend to reinvest their profits. Positive effect of dividends. Dividends also tend to have a positive effect on investor confidence, keeping them satisfied even when the stock price isn't rising. Dividends are seen as a sign of stability and financial health. How a dividend works. For example, if you buy 10 shares of a company and they announce a $1 dividend per share for this quarter, you'll get a $10 dividend payment. If they do this each quarter throughout the year, you'll end up with a total dividend of $40 for that year. Dividend yield. Dividend yields won't make you rich. On average, companies pay 1 to 2% of their stock price in dividends annually, with 75% of those in the S&P 500 index paying regular dividends. Dividend reinvestment programs. Some companies offer dividend reinvestment programs called DRIPs, which allow you to reinvest the cash dividend back into the company's stock, often at a discount. Dividend frequency. The company's board of directors decides how and how often to pay dividends, monthly, quarterly, most common in the United States, or annually. Types of dividends qualified. If you own the stock for more than 60 days before the ex-dividend date, these dividends get better tax rates because they are taxed at long-term capital gains rates. Unqualified, also known as ordinary dividends, these are taxed at your regular income tax rate because you didn't own the stock for long enough. Dividends from other sources. Dividends don't just come from single stocks. Many index funds and ETFs pay dividends based on the fund's net asset value. Dividends and stock prices. Once news of a dividend payment becomes public, investors tend to buy stock before the ex-dividend date, causing the stock price to rise. After the ex-dividend date, the price tends to drop because new buyers won't receive the dividend. Investing for dividends. It doesn't make sense to invest in something just for the dividends. Often, dividend payments result in slower capital appreciation. Stocks with exceptionally high yields may be in trouble, so it's important to look at the company's overall financial health. Don't forget to subscribe. If you found this video helpful, subscribe to Wealthy_Business and hit the notification bell to stay updated on all our latest content.